Yeah.
There's a real art to not leaving money on the table with these firms, and most people miss it. So the thing is, okay, wait, let me back up. I'm the head of content at Joinprop, and welcome to episode 15 of the Joinprop podcast. Today, we're doing a deep dive into this massive stack of 2026 trading data, leaked firm metrics, and some, like, honestly wild trader forums you all sent us. The mission today is basically decoding the actual strategy for extracting profit from an industry that is, frankly, designed to make you pay. So let me just hand the floor over to you so we can get right into it.
Yeah, hi. And, like, honestly, I have to stop you immediately, right out of the gate.
Uh-oh.
Leaving money on the table, because, leaving money on the table implies you, the listener, whoever's actually trying this, are making money to begin with, or, even sitting at the table at all. And from everything I'm looking at in these source documents, I am wildly skeptical that anyone is actually eating here.
Okay, well, people are making money. I mean, look, the landscape in 2026 is, are they, though? Because when you sent me this whole stack of research, I spent the whole weekend reading through the actual terms of service for these prop firms.
Right.
And it feels like a giant casino where the house just bought a Patagonia vest and is dressing up like a hedge fund.
No, look, the whole point of today, what we're trying to decode for you listening right now, is the actual mathematical strategy for maximizing profit without falling into those exact traps you're talking about.
Okay.
Because the money is there, it's real capital, it's just... People don't understand the mechanics of how to actually extract it. They get entirely caught up in the marketing.
Right, the neon signs, the Instagram ads.
Yeah, exactly. The flashy ads. So I want to start with the actual numbers, the brutal ones from the Q1 2026 data dump.
Let's hear them.
Because honestly, this sets the stage for why everyone messes up. And if you don't understand the failure rate, you literally can't understand the strategy to beat it. You ready for this?
Hit me. But I'm warning you, I'm already annoyed at this whole industry.
Okay, so... you have all these people taking the evaluation challenges, right? You pay a fee, you get a simulated account, and you try to prove you can hit a profit target without breaking the risk roll.
Right, the tryouts.
Exactly. 14% of people actually pass the challenge.
14. 1-4.
Right, 14%, which honestly, in the trading world, it isn't insane. Day trading is hard. But here is the kicker.
Okay.
Out of that 14% who get funded, meaning they prove they can trade, they followed the strict rules for a month, they got the live account, only 7% of them ever actually receive a single payout.
Wait, what? Let me do that math.
Yeah.
Half.
Half.
Literally half the people who prove they can trade to the firm's exact specifications never see a single dime of actual money.
Wait, that's literally their business model.
Well, no, it's not.
That feels like a scam. It just does.
It's not a scam.
You charge people to take a test. They pass the test against all odds, and then you somehow structurally ensure that half the people who passed never actually get paid. That's a scam. It's not a scam.
I'm not saying illegal. I'm saying it feels like one, like structurally. If I ran a business where half my successful clients magically never cashed out, someone from the government would investigate me. You can't tell me the house isn't rigging the roulette wheel once you pass.
Okay, look, let's unpack why that happens before we call the SEC. Okay. It's not that the firms are just flat out refusing to pay them. The firms actually want profitable traders, believe it or not.
I highly doubt that.
Okay, I'll admit, some rules are predatory. I will walk back my defense a little bit here.
Thank you, finally.
Some of the mechanics like trailing drawdowns and inactivity fees are 100% designed to catch people off guard.
Hold on, what exactly is a trailing drawdown?
Yeah.
Is that like a moving target for my losses? Because the documents mentioned it was buried in jargon.
Right, yeah.
If I'm listening to this and I'm thinking about paying $50 for an evaluation, I need to know what that actually means.
Okay, yeah. Let's do the math on a trailing drawdown because it is the perfect example of why people fail. Say you buy a $100,000 evaluation account. The rule says your maximum drawdown, your loss limit, is $3,000.
Okay, so if my account drops to $97,000, I lose the account. Simple enough.
Right.
Yeah.
That's a static drawdown. But a trailing drawdown follows your highest balance. So let's say on day one, you make a brilliant trade. You make $2,000 in profit.
Nice.
Your account is now at $102,000.
So now I have $5,000 of breathing room before I hit 97. I'm safe.
Nope. The trailing drawdown followed your high water mark. Your loss limit is always $3,000 behind your highest balance. So since your account touched $102,000, your new failure line is $99,000.
Wait, what?
Yep. So if you take another trade and it dips $3,000...
Which is normal.
Right, and you are now at $99,000. You lose the account. Your account is closed, your funding is revoked, and you are technically still up $1,000 from your starting
Are
balance.
you kidding me? You get fired for being profitable.
You get fired for giving back profits. Think of it not as a test of skill, but as a tightrope walk in a wind tunnel.
That's insane.
The firm isn't pushing you off the tightrope, but they've designed the wind, the trailing drawdowns, the strict time limits to ensure only the most perfectly obsessively balanced walkers make it across.
See, that is exactly why I'm calling it a scam. They are punishing you for normal market fluctuations. It's designed to make you fail so they keep your evaluation fee.
I hear you, and yes, the trailing drawdown is brutal, but, and this is a massive but, the vast majority of that 7% drop-off, the people who get funded and never see a payout.
Yeah.
It's not the trailing drawdown that kills them, it's the traders themselves. They lack basic emotional discipline.
Oh, come on. You're blaming the user. That is the classic tech company excuse. Our platform is perfectly fine. The users are just stupid.
I'm not saying they're stupid, I'm saying they lose their minds. Look at the common pitfalls listed in the psychological research from the forums.
Okay, let's look at it.
What happens is they get through the evaluation phase, right? They've been sweating, trading perfectly, managing risk. Then they get the funded email, the certificate. Suddenly, they log in and they have a $200,000 account. But it's not their money. It feels like monopoly money.
Right, because it's just digits on a screen. It doesn't feel like withdrawing cash from a bank.
Exactly. The psychological transition from the simulated evaluation environment to the live funded environment completely breaks them.
Oh.
Because during the evaluation, they would take a $200 profit and be thrilled. They hit base hits, but the second they get funded, they start acting like hedge fund managers.
Oh, I see.
They want a $10,000 home run on day one to post a screenshot on Twitter. So they massively size up their positions, they ignore the profit-taking rules that got them there in the first place, and they blow the entire account before the first 30-day payout window even opens.
So you're saying it's pure psychology. The firm isn't pulling the plug on them. The trader is just self-destructing because of the dopamine hit of being funded.
Mostly, yes. The pressure changes when it's real, or, ironically, when it feels so unreal that they treat it like a video game. And the firms know this, obviously. They calculate for it in their risk models.
Of course they do.
But it's not a scam to let someone over-leverage themselves if they actively choose to ignore their own strategy.
Okay, fine. Let's say I believe you that it's psychological.
It is.
Let's talk about the people who do survive. Because if the odds are this horrific, if I have to beat the 86% failure rate of the initial test and then the 50% failure rate of the funded phase just to get a single check, what on earth are the surviving 7% actually taking home? It better be lottery money. It better be life-changing. Or this whole industry is a waste of time.
Okay, let's talk about the 2026 earnings reality check. Because the money is real, even if the funnel to get there is tight. I'll just drop the stats right now from the aggregate data.
Okay.
Entry-level traders, like people just scraping by, surviving the month, maybe getting their first or second payout, they make about $2,000 a month.
$2,000 for beating a 93% failure funnel.
Wow.
Honestly, that's barely minimum wage in some states.
Yeah.
You're telling me I fight through the wind tunnel, survive the psychological torture chamber, and I get a part-time barista salary.
Let me finish. That's the entry level. Consistent performers, the ones who actually treat it like a business and survive past month 3, are averaging between $800 and $6,000 a month.
800 to 6K. Okay.
And the elite tier, the top fraction of a percent who actually master the system, they're exceeding $24,000 a month.
24 grand a month.
Uh-huh.
Okay. So roughly 300K a year.
Yeah. And just to give you context on the sheer scale of this, because I know you're skeptical that any real money is actually changing hands.
I am very skeptical.
Look at Apex Trader Funding. They're one of the biggest players. Since 2022, they have distributed over $598 million in payouts to traders.
Wait, $500 million?
Close to $600 million, yeah. And in late 2025 alone, they were averaging $15.4 million a month in payouts every single month.
Okay, I need a second. $15 million a month.
Mm-hmm.
Just from one firm.
Exactly. So the money is real. The pool of capital is massive. It's not a mirage. The problem is how people try to get their slice of it. Which brings me to the biggest, most mathematically destructive trap in the entire industry right now.
Which is?
The profit split.
Okay, yeah, explain this to me. Because everywhere I look online, every ad on my social media feed, it's just giant neon signs screaming, 90% profit split, keep 90% of what you make, which, again, rings my scam alarm. If a firm is giving me all the capital and taking all the risk, why are they letting me keep 90%?
Your alarm is right to be ringing, but not for the reason you think. The industry standard right now is 70 to 90% in the trader's favor, and everyone, literally everyone who signs up just sorts by the highest number.
Oh, yeah.
They see a 90% split from firm A and an 80% split from firm A, and they sign up blindly for firm A. It is a total sucker's bet.
Why? If I make 10 grand in the market, I want 9 grand? I don't want 8 grand. It's basic math. How is keeping more of the money a sucker's bet?
Because it's an illusion. It is entirely marketing smoke and mirrors. A 90% profit split with monthly payouts and scaling limits will literally yield you less annual earnings than an 80% split with daily payouts and unlimited growth.
What? No, wait, stop. How? That doesn't make any mathematical sense. 90% of a pie is bigger than 80% of a pie.
Because of the hitting mechanics of how you actually extract the money, let's do the math.
Okay, do the math.
Let's say you're on a 90% split. But the firm's terms of service dictate that they only let you withdraw your profits once every 30 days.
Okay, so once a month.
That means you make $10,000 in your first week, but you can't touch it. You have to leave your risk capital in the live market for the next 3 weeks, just waiting for payout day.
Oh, I see.
The longer your money sits there, the higher the mathematical probability that you hit a drawdown or hit a bad streak and lose the account before you can hit the withdraw button.
Okay, so you're risking your own profits.
Yes. You are forced to use your own profits as a buffer. Plus, the firms offering 90% usually cap how much you can scale your capital. So they might say, sure, keep 90%, but we'll never give you more than a $50,000 account.
Yeah.
Now compare that to the 80% firm.
The one taking a bigger cut.
Right. They take 20%.
Right.
But they let you withdraw your profits every single day or every 3 days.
Yeah.
So you make $2,000, you immediately pull it out. The 80% cut leaves you with $1,600, but it's in your bank account. It is safe from the market.
Safe from the trailing drawdown.
Exactly.
Yeah.
And usually these firms will double your account size every few months because daily payouts reduce their own institutional liability.
Makes sense.
So 6 months down the line, the 80% trader is trading a $200,000 account and pulling cash daily, while the 90% trader is still stuck on a $50,000 account, praying they don't hit a drawdown on day 29 of the month.
Wow.
The compound effect blows the 90% firm out of the water.
This is exactly what I'm talking about. How is a normal person supposed to know that?
That
If you're listening to this right now and you're staring at a shiny ad for a 90% split, you probably think it's a no-brainer. You're telling me hidden rules and payout frequency literally negate a 10% difference in gross profit.
I am.
That is intentionally confusing marketing. It's completely opaque.
I mean, it's business. You have to read the fine print. They have inactivity fees too, which eat into it if you don't place a trade.
Or normal people don't read page 27 of the terms of service to find out that a 90% split actually means they make less money because of a quote-unquote scaling limit. They just see the big number on the Instagram ad. It's predatory.
I wouldn't say predatory. I'd say, okay, maybe it's a little opaque.
A little.
But that's why we're doing this deep dive, right? To break it down, if you get caught up in inactivity fees or hidden platform costs for the data feeds, yeah, your 90% margin gets eaten alive. You have to look at the payout frequency first, always. Before you look at the split, you look at how often you can click the withdraw button.
All fine. So the 90% split is a trap. Half the people who pass fail anyway. So what is the actual mathematical way to survive this?
Survive the evaluation.
Yeah. Because if I'm going to subject myself to this psychological wind tunnel, I need to know how to hack the evaluation phase without falling into all these traps. Like, what are the 7% actually doing on a day-to-day basis?
Okay, so the single biggest metric, and this is heavily data-backed across thousands of accounts in the 2026 data we have, is the 2% rule.
2% rule.
Traders who keep their risk below 2% per trade are 40% more likely to succeed.
40%. Just by capping risk at 2%.
Yes, because it eliminates the emotional spiral. Think about it. If you risk 5% of your account on a single trade and you lose twice in a row, which happens to literally every trader on earth,
Right.
you're down 10%.
Okay, and if I'm down 10%, I'm probably close to blowing the account based on the drawdown rules you mentioned earlier?
Exactly. You're sweating, you panic. You realize you need a massive win just to get back to zero, so you try to revenge trade.
Revenge trade.
Yeah, you force a setup that isn't there, you size up to try and make it back in one swing, and you blow the account. But at 2% risk, you can take a string of 5 losses in a row, you're only down 10% total, and you can still calmly execute your statistical edge without sweating.
So it's not even about having a genius algorithmic strategy. It's literally just surviving your own boredom and impatience.
Exactly. Boredom kills more accounts than bad strategy, 100%.
I can see that.
People stare at charts for 4 hours, nothing happens, so they just click buy because they want to feel something, and that's when the firm takes their money.
Right.
But here is where the strategy to beat the evaluation gets really counterintuitive. During the evaluation phase, most firms require you to hit like an 8 to 10% profit target to pass.
Yeah, that's what the document said. You start with 100 grand, you need to make 8 to 10 grand to prove you're good, then you get the live account.
So what do most people do? They calibrate their entire trading system to aim for exactly 8 or 10%.
Makes sense. Why would you aim higher and take unnecessary risk?
Wrong. That is how you fail. The data shows you actually need to calibrate your system to target 12 to 15% gains. And you need to aim to complete the 30-day challenge in 15 to 20 days.
Wait, what?
Yeah.
Why would I risk pushing for 15% when I only need 10? If I hit 10, I pass. Pushing for 15 means I have to take more trades, which mathematically increases my risk of hitting a drawdown. That makes zero sense.
I know, it sounds entirely backwards. But think about the psychology of drawing out a challenge. The longer you sit in the evaluation phase, the higher the chance you tilt. Let's walk through a scenario. Say you are at 9.5% profit on day 28 of a 30-day challenge.
Okay, so I just need a 0.5% to pass. I'm basically at the finish line.
Right, but the market isn't giving you any good setups. It's choppy, it's sideways.
Okay.
But you know the clock is ticking. You have 2 days left. So you take a stupid forced trade just to cross the finish line. It loses. Now you're at 8%. You panic. You are so close. You realize you now need 2% in one day. You double your position size because you're desperate. Boom, you hit your daily loss limit, account blown on day 29. You have to start over and pay a new fee.
Okay, but aiming for 15%.
If your system is calibrated and aggressive enough to comfortably hit 12 to 15% in 20 days, hitting the 10% mark becomes a breeze. You cross the finish line with momentum rather than crawling across it bleeding and desperate.
I guess that makes psychological sense.
You want to access that live capital faster because sitting in the simulated environment breeds bad habits. It breeds that monopoly money mindset we talked about.
I kind of hate how much that makes sense.
Yeah.
It's like training for a marathon with a heavier weight vest so the real race feels incredibly light.
Exactly. You over-prepare for the target, so the target itself is just a waypoint, not the absolute limit of your capability.
Okay, so let's play this out.
Sure.
I survive the wind tunnel. I don't blow my account out of boredom. I cap my risk at 2%. I get the live capital.
Right.
I get through the first month without thinking it's a video game.
Okay, perfect scenario.
How do I actually get to that $24,000 elite tier? Because honestly, $2,000 a month is not worth this amount of psychological stress. If I wanted to make $2,000 a month, I'd go do literally anything else that doesn't involve trailing drawdowns.
So getting to the elite tier is all about capital scaling. You don't make $24,000 a month on a $50,000 account. You make it by scaling up to massive capital.
Right, so how long does that take? Do I just trade for 10 years?
Going from a base $25,000 account to a $200,000 account usually takes about 6 to 18 months, assuming consistent performance.
6 to 18 months, okay. How does the mechanism actually work? Do I just email the firm and ask them for more money because I had a good month?
No, it's completely algorithmic. A lot of the top firms in 2026 offer an automatic 25% bump in capital every 4 months if you maintain profitability without breaching any of your drawdowns. Or, even better, some of the really aggressive firms will literally double your allocation the second you hit a 10% profit threshold on the live account. Make 10%, boom, your buying power doubles instantly.
Doubling it is wild, so you just snowball the account.
Yeah, but that's just the basic linear scaling.
Yeah.
If you really want to jump to the elite tier, the people making $300,000 a year, you have to use advanced strategies. And this is where things get really intense. I'm talking about multi-account diversification and firm arbitrage.
Uh-oh. I don't like the sound of this.
It's where the real money is.
This sounds like the part of the movie where the main character gets too greedy.
No, listen. The data shows that running 2 to 3 accounts simultaneously can generate 150 to 200% more profit than just focusing on a single account.
Are you kidding me right now?
Yeah.
You literally just spent 10 minutes condemning people for overtrading. You said overtrading is the #1 killer. And now your big advanced strategy is to trade 3 separate accounts at the exact same time. That sounds like a complete house of cards. It's incredibly reckless.
It's not overtrading. You aren't taking 3 times as many setups.
You literally are.
No, you're using copy trading software. You take one setup, and the software perfectly mirrors that exact trade across 3 different accounts at 3 different firms in milliseconds.
That is the definition of reckless. If your trade goes bad, you aren't just losing on one account, you're blowing 3 accounts at once. You're tripling your downside.
But we're capping your risk at 2%. Across the board, it's the same risk profile. You're just multiplying your edge.
Yeah.
Look, the math...
The math doesn't protect you from a flash crash. If you have 3 accounts and you hit a massive intraday drawdown, you lose all of your funding overnight, all of it.
Yeah.
That is a house of cards waiting to collapse the second the market gets volatile.
Okay, but that's where firm arbitrage comes in. You aren't just blindly duplicating risk. You leverage different rules across the different firms to protect yourself.
I know.
Let's say you have an account with firm A and an account with firm B. Firm A has that brutal trailing drawdown we talked about, calculated tick by tick.
The wind tunnel.
Right. But firm B has an end-of-day drawdown, meaning they only calculate your balance when the market closes at 4 p.m.
Okay, so they have different rule sets. How does that help me during a crash?
Let's say a news event hits. The market violently spikes down, then immediately recovers. It happens all the time. Firm A, because they track tick by tick, liquidates your account mid-candle. You're out.
Right.
But firm B, because they only check at the closing bell and the price recovered by 4 p.m., your firm B account survives. You're still funded. You're hedging the structural rule sets against each other. You essentially bought insurance by paying 2 different evaluation fees.
I mean, honestly, this just sounds exhausting. You're fighting the markets, you're fighting the algorithms, and now you're fighting 3 different sets of corporate terms of service.
It is a business. That's what I'm trying to say. Elite traders don't just click buttons based on a gut feeling. They run a highly sophisticated operation. To pull this off, to run firm arbitrage with copy trading software, you have to track insane performance metrics.
Like what?
Like you need a custom dashboard monitoring your Sharpe A ratio, your win rate, your profit factor, and your average R multiple across all platforms.
Stop. Time out. R multiple.
Yeah, R multiple.
What is that? Don't just throw jargon at me.
Yeah.
If you're going to drop terms like that, you have to explain them.
Oh, you don't know R multiple.
No, I don't know R multiple, and I guarantee the person listening who's thinking about dropping $500 on an evaluation doesn't know either. Explain the mechanism.
Okay, my bad. So R multiple just stands for risk multiple. It's basically how much you win relative to what you risked on that specific trade. So if you risk $100 on a trade and you make $300, that's a 3R trade. Your profit was 3 times your initial risk.
Okay. Why not just say risk to reward ratio? Why do finance bros have to invent a new letter for everything?
Because risk to reward ratio is what you plan to do before you enter the trade. R multiple is how you track the actual historical outcome of your entire system.
Okay.
If you track your average R multiple over 100 trades, you know exactly what your statistical edge is. Let's do the math again. If your average R is less than 1, meaning you usually risk $100 to make $80, you have to win a huge percentage of your trades just to break even.
Obviously.
But if your average R is, say, 3, meaning every time you win, you make 3 times what you lose.
Then I can afford to be wrong a lot more often.
Exactly. You can literally lose 60% of your trades. You can be wrong more than half the time, and with a 3R average, you will still be wildly profitable at the end of the month.
So the elite guys tracking 3 accounts are basically just optimizing their R multiple across different firm rules to ensure that even if they get liquidated on one account, the 3R wins on the other accounts mathematically cover the loss.
Yes, exactly. It's purely mechanical. It strips all the emotion out of it.
Okay, I see.
But okay, we have to talk about the final boss.
Final boss.
Yeah, because even if you do all of this perfectly, you survive the evaluation, you don't overtrade, you set up the copy trading software, you have 3 accounts, your R multiple is a beautiful 3, you're making 50 grand a year in payouts.
That's great.
There is one thing that destroys more profitable U.S. traders than anything else we've talked about, and it has absolutely nothing to do with the stock market.
Let me guess. The government.
The tax hammer.
Yeah.
It is brutal. It wipes people out completely because they don't see it coming.
Okay, I actually thought about this when you were talking about making 150% more profit with multiple accounts. If you're suddenly making 300 grand a year or even 50 grand clicking buttons in your basement, the IRS is going to notice that cash hitting your bank account.
Notice is an understatement. So here's the gut punch statistic for U.S. prop traders. Because you are not technically trading your own money, you're trading the firm's capital, you do not get favorable capital gains tax rates.
Right.
You are classified legally as an independent contractor providing a data service to the firm.
Oh, I see where this is going. You're a 1099 worker.
Exactly, which means you get hit with a 15.3% self-employment tax. That's for Medicare and Social Security. And you have to pay that on top of your regular federal and state income tax brackets.
Oh, my God.
Yeah. Let's look at a $50,000 payout for the year. That triggers $7,650 in self-employment tax alone. That's before you even pay a single dollar of federal income tax or state tax.
That is nauseating. So you're losing, what, 40% of your money?
Easily, in some high-tax states like California or New York, you could be giving almost half of your prop firm payouts back to the government.
Wow.
Which is why the final piece of the 2026 strategy, if you are making over 50 grand annually, is structuring. You absolutely have to set up an LLC and elect to be taxed as an S-corp.
Wait, you have to form a corporation just to trade?
Yes, because if you structure yourself as an S-corp, you don't pay that 15.3% tax on all your earnings. You pay yourself a reasonable salary on a W-2, say, $40,000 out of your $100,000 profit, and you only pay the self-employment tax on that 40 grand.
And the rest?
You take the remaining 60,000 as a shareholder distribution, which bypasses the 15.3% hit entirely. It saves you thousands of dollars.
The irony of this is unbelievable.
How so?
You start out as some guy in his basement, casually clicking buttons on a 30-day challenge, hoping to make a quick buck to pay off your car. And if you actually succeed against all these horrific odds, you end up having to incorporate a literal business, hire a CPA, run corporate payroll software, and issue yourself shareholder distributions just to survive the tax hit.
Yep. Welcome to the big leagues. It's not just drawing lines on a chart anymore, it's corporate structuring.
Look, my brain is kind of fried from the math here. We went from trailing drawdowns to FICA taxes in under an hour. We need to wrap this up.
Yeah.
But just, okay,
Wait, I didn't even get to talk about withdrawal timing, because if you withdraw on a Friday, the latency with the ACH transfers?
nope, we are stopping there. No more hidden rules, no more latency traps.
Mhm.
I'm going to give the takeaways because someone listening needs to make sense of this before they go spend their money.
Right, hit 'em.
Number one, do not get blinded by the 90% split. It is a marketing gimmick. Look at the payout rules and the withdrawal frequency first. Number two, if you risk more than 2% per trade, you're dead in the water. It's pure statistics. You will spiral emotionally and fail. And number three, if you somehow survive the wind tunnel and get funded, hire an accountant immediately before the IRS takes half your money.
Actually, that's a pretty solid summary, but I want to leave everyone listening with one final thing to chew on. Building off what you just said about the irony of starting in a basement. Think about the progression we just outlined.
Okay.
If you are actually pulling this off, if you've incorporated an S-corp, hired an accountant, you're running algorithmic copy trading software across 3 separate institutional data feeds, and you are actively hedging corporate terms of service against each other, are you really even a retail trader anymore? Or have you basically just built a micro hedge fund out of your spare bedroom?
That is terrifying to think about. Did you want to build a business or did you just want to trade?
Right. It's a completely different job than what you signed up for.
Yeah.
Anyway, that's all for today. Thanks for hanging with us. We'll be back next week with more. We're getting into platform latency next time, which is going to be crazy.
Yeah.